Hey everyone, welcome back to Corporate Decoder, the place where we dig into the confusing world of corporate finance and try to find some juicy gossip hidden in the paperwork. Today we're looking at the Federal Home Loan Bank of Des Moines' latest filing. Will it be a beacon of financial stability, or will it reveal some cracks in the foundation? Let's find out. So this is a current report, meaning something interesting happened recently, specifically around the 20th of October 2025, and it is from the Federal Home Loan Bank of Des Moines, or as we'll call them, the bank. They're a federally chartered corporation, which means they're a big deal in the US financial system. Now, what exactly does the bank do? Well, they get their money mainly by selling debt. Think of it like borrowing money from the public by issuing bonds and notes, which they call consolidated obligations. And here is a key point. These are not just their obligation, they are the joint and several obligations of all 11 federal home loan banks. That means if one bank can't pay, the others have to chip in. This sounds like a safety net, but it also means everyone's on the hook for each other. They are regulated by the Federal Housing Finance Agency, and this agency has the power to make any of these banks cover the debts of another bank. So these consolidated obligations, they are backed only by the financial resources of these 11 banks and are not guaranteed by Uncle Sam's government. That is pretty important to remember. Now, the filing itself is a bit dry because it is mostly about their debt. Item 2.03 is about the creation of a direct financial obligation, or an obligation under an off-balance sheet arrangement. Basically, they are telling us about money they owe or are responsible for. They refer to something called Schedule A, which lists all the consolidated obligation bonds and discount notes that are planned to be issued by the federal home loan banks, when our bank is the one primarily responsible for paying them back. They also include any debts where they've taken over the main responsibility from another federal home loan bank. They do exclude short-term discount notes due within a year, which are pretty common for them. They make a few important points about this Schedule A. First, even though issuing these debt obligations is a big deal for the bank, they haven't decided if any single one of these debts is super important on its own. That is a bit of a curious statement. It is like saying, we have a lot of debt, but we haven't picked out the most dangerous one. Also, Schedule A doesn't include any of their interest rate swap agreements or other fancy financial tools they use to manage their risks. These could be directly or indirectly tied to these debts. So, what you see on Schedule A might not be the full picture of their financial maneuvering. And another crucial point, Schedule A won't help you track the total amount of debt they owe that they are primarily responsible for. This is because, as we mentioned, they leave out the short-term notes and don't show if this new debt is just being used to pay off old debts that are due. So, if you want to know their total debt, you'll have to look at their regular reports filed with the Securities and Exchange Commission. This means Schedule A is more of a snapshot of new debt commitments, not a clear picture of their total debt load. Finally, the amounts shown on Schedule A are the face values, or the par amounts. This might be different from what you see in their official financial statements because of things like discounts or premiums that aren't included in the face value. This is common, but it is another reason to pay attention to the full financial statements when you want the precise numbers. The actual details of what debt they've committed to are in Exhibit 99.1, which is Schedule A. Unfortunately, we can't see their actual Schedule A in this document preview, so we can't dive into specific numbers of bonds or notes issued here. But the explanation they give tells us a lot about how they manage and report their debt. Now, let's look at the bigger picture here. The Federal Home Loan Bank of Des Moines is a crucial part of the US housing finance system. They provide liquidity to financial institutions, meaning they lend money to banks and other mortgage lenders. This helps keep the housing market flowing. Their main source of funding is indeed these consolidated obligations. What this filing essentially communicates is their ongoing reliance on the capital markets for funding. They are committed to issuing more of these joint and several obligations. The complexity of their reporting, especially with Schedule A, highlights the intricate nature of financial institutions. The fact that they exclude short-term debt and details about debt maturity and replacement means that investors need to look at other filings for a complete picture of their financial health and debt exposure. For us as observers, this filing is a signal that the bank is actively managing its funding strategies. The joint and several obligation aspect is a key risk and a potential strength depending on how you look at it. If the financial system as a whole is strong, this structure helps provide stability, but if one or more of these banks face severe distress, it could ripple across the entire federal home loan bank system. In my view, the Federal Home Loan Bank of Des Moines, like many similar institutions, operates in a world where a significant portion of its operations revolves around managing debt and financial instruments. The limited detail provided in this specific filing, particularly the exclusion of short-term debt from Schedule A and the lack of information about how new debt is used for refinancing, suggests a need for caution and further investigation for anyone looking for a complete financial snapshot from this report alone. They are actively borrowing money to keep lending, which is their core business, but the way they present it requires a keen eye. Alright, that is our breakdown of the Federal Home Loan Bank of Des Moines' latest filing. What is your take on their debt management strategy, and what does this reliance on consolidated obligations mean for the broader financial system? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.